Good Monday. This is Jay Brew, co-chairman of Seifried Brew. I hope everyone out there got their comment letters in on the Basel III capital proposals. And our hope is that with your comment letters, and many bankers have sent us copies of these letters, which have been really great in here, that essentially along with the 53 senators signing, with the ICBA and the ABA going in there and fighting the battle, that hopefully we'll get changes in terms of those capital proposals in one way or another. But you have to sit there and think, well, what if they aren't changed? What if Basel III goes through? And that's why, as part of capital planning, you want to consider the effects that may happen to Basel III on your overall bank. So when we think about that, is that I'd like to review with you the Seifried Brew essentials of capital planning. Whether or not Basel III goes through or not, or whatever new capital proposals come out, is that we want to be prepared as community bankers. We want to go into our current capital plan and we want to sit there and look at it from a number of different viewpoints, and you need to follow our essentials in terms of what needs to be in that capital plan. So the first essential in here is the strategic planning model. And we are big advocates of modeling a community bank's balance sheet and income statement out 5 years, even 10 years. So when we look at that, we can see how capital is going to grow over that time period. We can also then look at our growth assumptions. We can look at our income assumptions, our dividending where applicable, and look at our future. A lot of banks sat there back during the Great Recession and said, we don't know what the future is even going to look like. But the banks that thrived, that looked out 5 years, now looking with the fact of, well, are interest rates going to remain low? Could they start to move up? Affects the results of your model. And then you can look at any sort of capital proposals and say, how does this overall affect us? What is the effect of Basel III? The second essential in here is looking at risk and assessing risk. And we want to look at credit risk. We want to look at earnings at risk. We want to look at liquidity risk. And to be able to assess, do we have enough capital now and into the future based upon our strategic planning model to have enough capital to offset the risk. So this risk assessment piece is very important. Then number 3 is going to be the economy. And we're going to look at the economy from a local, state, and national level. Not only where it is, but where is it going? So that economic risk piece is very vital in here going forward. 4, what we're going to look at are stress tests. And I'm a big believer in stress tests on that balance sheet. Looking at it from the standpoint of liquidity stress, looking at it earnings stress, and then looking at credit stress. And going through those stresses, do we have enough capital to be able to take, say, the stress of another Great Recession? Not that we're expecting it to happen, but we want to plan in case we were to go back into a period like that. The 5th essential in here is looking at concentration risk. And when we think about concentration, that was a big major factor in the failed banks. They had too much of a concentration in construction and development loans. They had too big of a concentration in borrowings from wholesale sources. So when we look at concentrations in the bank, what kind of risk is that? And do we have enough capital to be able to offset that concentration risk? And then what we're going to do is that we're going to set minimum levels of capital. When we think about these minimum levels, we just don't want to take the regulatory minimums, even under the new Basel situation. But we can apply looking at Basel III in that minimum and also with that cushion that they were talking about that sets dividends, that buffer zone. And when we think about the minimums, that do we have enough capital that if some of the Basel III proposals came through, would it affect our overall capital position? What do we need to do to plan into the future to either build capital or maintain capital? And that's a big piece with whatever proposals come out, is that we want to set minimums based upon the risks that we're taking. Finally, when you look at event triggers and you look at those overall event triggers on many different levels, because we need, as community bankers, warning signs. We need warning signs of external event triggers. Event triggers like what happens if the 10-year goes above 2.2%, for instance, which is pretty much what I look at as the trading range that we've been working down and up to. That if we breach that level, that we need to be aware that certain things could happen. It might involve selling investments, for instance, with the B&K trigger strategy. Then you look at contingency planning. And within contingency capital planning, how are we going to raise capital? What amount are we going to raise in capital? How long will it take us to do it? So when we look at these essentials of capital planning, you want to make sure that each one of these is in your capital plan, and then what you want to do is to apply it based upon what you think the capital proposals might be, what Basel III has, and then look into the future to say, do we have enough capital to offset any risks that we're taking, to preserve and build capital into the future? This is Jay Brew. Have a great week.